How are you doing? Hope you're doing well. So today I want to talk about price action to either beginners or people who still don't understand this properly. So, for example, what is price action in the first place? Price action is the study of how smart money delivers price from one area of liquidity to another, and in terms of ICT, because when it comes to liquidity, that's mostly an ICT concept. Price is not moving randomly, and it is being engineered by algorithms which often seek liquidity from premium to discount, and from sell side, from buy side to sell side. And this algorithm, most of the time, it does, engineer liquidity in terms of inefficiencies, for example, fair value gaps, and it comes later to refill them, and to deliver price, to predetermined objectives. So always when you hear people talking about prices, already booked, yeah, that's what they mean. So this is going to be a good one. My name is Rocky Calvin, and welcome to Question Trading. I've been having a flu recently, and that's why I was not even able to, like, I was not even planning to do this video, but I'm just going to do this. I'm going to give you exactly what's happening here with gold, because this is real time what's happening here right now. So you guys can be able to, can understand. So once you guys have understood what is price action is just how smart money delivers, price from one area of liquidity to another one, okay? And it is also a study how you see the algorithms, seek liquidity, rebalance inefficiencies, and deliver price, to predetermined objectives, meaning that it had already determined on what exactly to do. Okay, so the first question that you're supposed to be asking yourself, instead of looking at indicators, or retail chart patterns like double top, double bottom, and so on, the question that you're supposed to be asking yourself is like, where is price seeking liquidity next, and how is it likely to get there? This is the most important question. Ask yourself this question: where is price likely to seek liquidity next? Now, this depends on a range. If you're dealing in a range of, for example, let's assume you were definitely in this okay, trading from today. This is today, Tuesday, right? No, when is this? Sorry. So the question would be, if we opened right here, where is price seeking liquidity next? So we have some liquidity right here. We had some inefficiency right there, and also had some, I think, liquidity. All you see, these are relative equal lows. Okay. But also there's something known as market structure, which I'm not going to be talking about. I think I did it on another video, but I'm going to talk it a little bit later on. Market structure shift here. So this tells you where the price is interested in, pushing towards. This happened the previous day. So in open here, so we're just asking ourselves a question. We have market structure shift here, and inside this range, we do have some liquidity lying down here, and we have an inefficiency. So you have two options. Remember, in price action, this algorithm is just seeking liquidity. Liquidity is money. There's some people who already bought, and they've put their stop losses right here. Others have and others have put their stop losses, just below this candle, right? So what is the algorithm supposed to be doing? Now the smart money sees and knows this. So price comes and takes them out. After taking them out, it also comes and takes these ones out, because they never understood the concept. This is liquidity. This is an inefficiency that price had engineered and had to come back into that area. You see, price comes back in there, takes them out, and it consolidated there for a couple of hours. Then later on, when smart money comes in, for example, during I believe New York Open, yeah, you see price now coming back, now exactly pretty much the same area, because you see this entry. If I draw something, let me show you something, guys. If I draw something like this, right? If I draw something like this is the inefficiency right there, that we created, during CPI. This was news, right? You see now during New York session, price is now coming back to the same PDRA down there, and now starts pushing higher, meaning that now these are very safe, a safe place to put your stop loss, because this move here has taken liquidity from this low to that PD array. Okay. Now I want to give you guys a very good example here uh, on price action. Let's use, for example, where they're right now here. So imagine the market has just formed relative equal highs. This one's here. You see this market. This one. You see this. This is relative equal highs. This one's you're seeing here. Yep. Okay. So imagine the market has formed relative equal highs, during maybe, let's say, London session, or maybe Asian. Definitely, this is Asian, right? I'm using UTC plus 3, so that's going to be different. If you're seeing confusion from your side, just know that I'm using a different time zone. I'm using UTC plus 3. Okay. So these are relative equal highs during Asian session, right? So what do retail traders see? Retail traders will see, for example, this is gonna be, to them, this is gonna be resistance. Okay, so if they're seeing resistance, and they start, placing sell orders, or they start selling right here, so they're selling, and they're definitely targeting these lows here, right? So this is the mind of a retail trader. So they're seeing, they're seeing something like, resistance here, and definitely some would even cross some stuff here, and so on. So they see, uh, you know um, what do they call it? They see resistance there, right? So they start, putting sell orders, below it, while buy stops from earlier sellers, accumulate above the high. So the ones who are, already maybe sold it from somewhere in here, and so on, they've put their stop losses right up there. Some have put their stop losses right here. The ones who sold it from maybe this area here, stop loss right here. Some who sold over here, stop losses above there. Okay, this is the mind of a retail trader. And what are they targeting? They don't trade this, they understand nothing about inefficiencies. All they know is we have some maybe double bottom down here, and this is their next destination, right? They understand nothing about market structure shift. Okay, so they have sold, and you see price started dropping while they start going down. Then New York comes in, New York Open, which is 9:30. New York, and we had CPI news during this time, so CPI did the damage. Actually, it was around 3:30 using UTC plus 3. So CPI did the damage instead of New York Open. So assuming New York opens or the CPI comes in, what does CPI do? It goes and removes all of them, their stop losses. They lose money here, and they'll be like, wow, you are, almost to take profit down here, price, reversed, and these banks, and these people, they're trying to scam us our money, and okay, that's how they should complain, right? They don't understand what was happening here, why they were stopped out. Okay, so after they're stopped out, some others, or some other traders, or some retail traders will see now, for example, after New York Open, or this news here on at this time pushes above this level, and what do they see? A breakout. They see a breakout. Okay, so they see this is a bullish breakout, and what do? They start buying again. So they start buying here, putting their stop losses down here. Some will put their stop losses down. Some will put their stop losses down here. In one or the other, for these ones who have put their stop losses down here, in one or the other are gonna win it. But you see, the risk to reward of this is not mathing up. It's not making sense. And this is a very dangerous way to look at price. So, for example, because all they see is a breakout, they wait for price to come and retest that breakout. They buy it from here. Stop loss is all the way down here, or maybe stop loss is down here. You see what happens? Some are putting over here. Okay, so to a smart money trader, or to an ICT trader, they're gonna be seeing this as a buy side liquidity sweep. But understanding the context that we are in a bullish move because we had a market structure shift. Okay, and market structure shift is definitely, you see, is a situation whereby, you see, if price has been making, let's say, for example, price has been making let's say price has been making higher highs. Okay, higher highs and higher lows, like in this scenario here, higher highs, higher lows, higher highs, higher lows, right? Then after sweeping liquidity, for example, up here, we've swept some liquidity. Price aggressively breaks below the most recent low with the displacement. So for example, let's say here, you see it. So for example, let's say here, then this is what now the ICT traders or smart money traders would call market structure shift. This one here, because price just displaced aggressively after price has taken liquidity above above these highs, right? And then abruptly it just comes, pulls down, below some swing low or some recent low with with the displacement, meaning that it created a gap. Okay. And the next objective for this type of trader will say, oh, nice, now this is a sell, and this is happening on a premium area. So when price retraces back to this gap, they're definitely going to sell it to the downside. These are NICT things. Okay. So price action in price action, structure often changes, reversal. No, sorry, structure often changes in and reveal changes in an institution intent. I don't know if I make sense with what I'm saying. Structure changes always reveal changes in institutional intent. So if a structure changes here, that is just indicating structure changes, or they reveal changes in institutional intent, like it wanna go a certain direction. Okay. It gotta show you like I wanna go somewhere first. But remember, we're in a very bullish market. So even if you wanna sell this, down, your point of interest is not supposed to be, liquidity down here. It's supposed to be this imbalance, because meaning that it's coming back to tap in some traders who did not get this entry here. Okay. So this is in terms of relative equalizer. For example, over here we had some relative equalizer. You see, price went and attacked them. After attacking them, we had some traders, for example, the retail traders, they had marked this high, maybe this high like this. Okay. Then now they see a breakout. What do? They start buying. Yes, they're on the right track, but literally this is not how you're supposed to be looking, because a smart money trader will be like, okay, I've seen some liquidity, some relative equal highs patched there. So wait for price to have a market structure shift to the downside with a gap. We sell it. What are we targeting? Because we have a market structure shift down here in the first place. So it is from premium to discount. And they have something like equilibrium within this area here. So they definitely be selling, targeting this PDRA. But once price comes back here, they understand very well that we were supposed to be pushing high. So this is just retracement, because this market structure shift here in higher time frames, gold is kind of bullish. Okay. Now leave that behind. If you take a look at what's apparently happening right here right now, when we opened here today, price came to to tap entry here for people who not getting. But unfortunately, if you don't understand the concept of time and price, some people would have already bought here, and maybe because now they see this, they put their stop loss down here, they already stopped out. Stopped out. Why? Trading the wrong time. So you need to know time and price. There's specific time where specific things are supposed to be happening. It is not by mistake. This thing is designed to work as such. Okay. And this is what has been, even you see this move that we had here, guys, this was there's a reason why price came here. There was a PDRA. I think in the previous weeks price never visited, and this week it visited it. I think it was yesterday, and now finally we've swept some liquidity. We visited that PDRA. I think it was somehow like ups and so on. Now it's time to push higher. Now pushing higher, do you know what's happening here right now? This aggressive move you're seeing here, this candles, this is an issue of US and Iran. Seems like they're having a deal again, because Trump just said that Iran just called there and they want to make a deal. That's you see, those manipulation are the kind of games they play with people. So how does that align with this? It is time and price. What time is it? It is time when Iran and US are wanting to to make a peace deal. right? And where's price? Price is on a discount level. If we grade this as a range, for example, this is discount, this is premium, this is a range here. We're on a discount. So where are we? We're on a discount. Okay, perfect. How, like, what was price doing down here? Price came back to balance these inefficiencies, and it's done doing that. So what next? We have liquidity up here. We have inefficiency up here. Your target should be this. This is where price is headed to next. This inefficiency here. Depending on how price is going to behave here, but I feel like price is really going to go higher than this. All this liquidity up there is going to be taken out. So depending on how price behaves up here, if you end up disrespecting this PDRA here, we push high, we go higher than that. So if you wanted to engage these markets, definitely right now you cannot buy it right now where it is. You're already in premium. Why are you buying in premium? Wait for price to come back to discount or at least equilibrium. So in other terms, we do have a market structure shift here. So I expect price to come back again down here. When it comes down here, engage, put your stop loss down here. This is safe because liquidity was already taken here. You see this liquidity was taken. This was liquidity. And definitely I think it was land no Asian liquidity was resting here. It was taken here already. It was taken by London. London took out Asian. And you see New York just came back to retest that area. You see how fast it is rushing towards that bid area right there. Yeah, so it's going there to just balance this out, but depending on how it's going to be behaving there, that depends. So after taking this liquidity and balancing that, we might have a retracement to the downside before now price pushing further. Okay, this is how to read price action. There's more to this. There's more to this, but this is just the introductory part of it. So you guys make sure you learn correctly. And I usually have a concept that, like me personally, I would call it's a cash line concept. And with cash line concept, there's a first question that I usually ask myself whenever I open these charts. I often ask myself the first question: where is price coming from? Because where price is coming from will tell me where it is likely going to. Okay, because sometimes you can be, let's say you can be over here and you're saying, you see, we've taken some liquidity, so where we go, we're pushing higher. But what if price hadn't taken in liquidity yet? Meaning that liquidity still, there's a drawn liquidity down here, so you want to buy here, putting your stop loss here, but there's liquidity resting here. So the first question, where is it coming from? Have we taken some liquidity? Have we balanced some PDRA? And how has price reacted in those PDRAs? These are some very important questions that I usually ask myself before I engage. So depending on the answers that I get, that's how I be able to, to map out how I'm going to attack this price action. Okay. So that being said, this 20 minutes, so I'm going to let this one go. So you guys check this one out and make sure to learn correctly. I'll see you in the next one.